balance of this session, we will discuss the alternative minimum tax. This tax, or AMT as it is usually referred to, was introduced in 1970 as a way to ensure higher income taxpayers paid some income tax irrespective of how many deductions and tax loopholes they used. The basic idea was that no taxpayer with substantial economic income can avoid significant tax liability by using exclusions, deductions, and credits. The aim was to guarantee that all wealthy taxpayers pay at least a minimum amount of income tax. For the most part, individual taxpayers with taxable income below $100,000 do not need to worry about AMT, nor do married filing jointly taxpayers with taxable income less than $175,000. Because of these high income requirements and other factors, AMT appears less than 10% of the time on a tax return. For this reason, I'll mention it only briefly here. The workbook has clear instructions and guidelines for the most common and relevant AMT rules. This will help you determine whether a client needs to pay AMT and how that calculation is to be made. However, don't let these assumptions mislead you. If, for instance, the taxpayer's taxable income for regular tax purposes, when combined with certain adjustments and tax preference items, is irregular, he may have to pay AMT. There are a number of things that could trigger AMT, such as a high number of personal exemptions, uncommon itemized deductions, the gain or loss on the sale of property, incentive stock options, passive activity losses, depletion, intangible drilling costs, and tax-exempt interest. Yes, even tax-exempt interest could affect the amount of tax that the taxpayer has to pay. Just a high amount of expenses may be enough to put your client in line for AMT. Form 6251 must be filled out for those taxpayers who are targeted to pay AMT. The instructions for that form are detailed but complete in helping you advise your client and fill out that AMT form. The alternative minimum tax amount is then added to your client's tax return.